We made some trades lately. Want to talk about them?
Let's do it.
First, I guess you should tell people who you are.
Josh Sheluk, Chief Investment Officer and Portfolio Manager at Verecan Capital Management.
Josh, I hear we just sold Generac. Tell me about it.
So just to give a quick overview of what we did with Generac earlier this month, we trimmed our position in Generac, which we've held for, I believe, a couple of years now as an individual stock. Now, Generac, just as a refresher for our listeners, it's a company that provides generators for residential and commercial industrial use. We actually added to this company just a few months ago, added to the stock position that we had, thinking that it was quite undervalued at the time. The stock price had come down quite a bit over the course of this year. And the timing on that really couldn't have been much better. Again, sometimes you get lucky with timing, and I'd say that was part of it, part of our discipline, but partly luck as well. And it's just been kind of on a rocket ship since then. So probably up about 40% or so, maybe a little bit more since we added to the position just a few months ago. So the party we don't think is over because we still maintain a healthy position in Generac, but we had seen a couple things happen. One, it got pretty close to our target price. That usually is an indication for us that there's maybe less upside than we would have thought previously. So it's worth taking some chips off the table, so to speak. The other part is always about risk management for us. And whenever a position gets too large as a part of our overall portfolio, we want to scale back. We never want to see one position, one individual stock represent more than about 2-ish% of our overall equity portfolio. There's something like 30,000 stocks in the world that you can invest in. So to have more than 2% of your portfolio in one company for us is just not really necessary. Diversification is just such a major tenet of our investment philosophy.
Thanks, Josh. Am I hearing this right? Did we ditch our undies?
So I still have underwear on, if that's what you're asking me right now. But we did sell our position in Hanesbrands, a company that we've held a stock position in for a very long time now, actually, probably one of our longest standing positions in the portfolio. And so we sold it earlier this week because the company is being taken over. So the stock price has rallied quite a bit on that takeover news. It's not even news at this point. It basically looks like it's a done deal. And the details of the takeover are out there. So the company that's buying it, actually a Canadian company, Gildan Activewear, is going to buy it for a combination of Gildan shares and cash. And when we looked at it, we just thought, you know what, we don't really want to hold shares of Gildan, and we would probably have to wait sometime into the new year to actually see this deal come to fruition. And by the way, it's trading at seems like a slight premium to what the deal price is. I did want to mention that this is kind of a disappointing outcome for us on Hanesbrands. We really did not see the success that we would have expected on this position. We bought it several years ago. It hasn't grown the way that we wanted. It ran into issues with what we thought was a bit of a turnaround story early on, didn't quite get there. And because it had slightly higher debt as well, then that makes turnarounds more complex and more problematic if that turnaround doesn't happen in a reasonably short period of time. So ultimately, disappointing result for us on that one. We've had a lot of successes on our individual stock selection recently, but that's not one of them ultimately, even when you consider that it's been taken out. So you always look at these instances or examples as looking for something that you can take away from them, something that you can learn from them, and we'll certainly do that. We thought that, you know what, let's take our cash, we'll go find different opportunities now and redeploy the cash into something that we think is going to grow better over time.
And what is that?
Well, that's Agilent Technologies, quite a different company than Hanesbrands. It's a medical technology company. They provide technology to pharmaceutical type companies and a variety of other academic institutions, government institutions, for a variety of purposes, really. But the technology is really interesting with this company, Agilent. They're kind of at the forefront of the medical tech space. They have a sort of a competitive advantage in their technology, and it's a company that's growing well in a sector, healthcare, that seems to be advantageous and have a lot of tailwinds associated with it. And it's a company that we think can be a really good piece of our portfolio going forward and should have some good tailwinds behind it. The healthcare space right now is, as much as I say we think that there's some tailwinds there, there's a few clouds overhanging the space. And actually, that's why we think there's a pretty good opportunity here. So there's a couple what I call black clouds at the moment. On the regulatory and geopolitical side, healthcare is coming under fire. Now, it's not so much the medical tech space where Agilent is focused, but definitely the pharma space and some of the insurance providers are under pressure, as so many areas are under pressure, specific political regimes right now. This one's no exception. The other part, the other sort of black cloud is tariffs, and tariffs are kind of overhanging this industry. There is some cross-border exchange as it goes with the healthcare space, so that's another one that's providing a bit of concern around the industry at the moment. And then I would actually point out to the third one. I'll call it a gray cloud, because COVID, as much as it accelerated so many things several years ago, we're seeing a bit of a hangover from that now, where there was a bunch of front-loaded spending in the 2020, 2021, 2022 period. And now companies that are relying on spending in the healthcare space have had a bit of a lull. And this is not specific to Agilent, it's more of an industry-wide thing. But if you believe that some of these clouds will clear over time, and we certainly think that there's an opportunity for that, then healthcare seems to be pretty well positioned to, again, benefit from some of the more secular tailwinds that we think exist. And all of these things, all of these clouds that I've described, I would also describe them, in our opinion, as temporary. So hopefully we see some of those clouds clear. And the reason I think that the tailwind is potentially so strong is because the healthcare sector, from a valuation perspective, is trading at something like its lowest level versus the rest of the market in very, very long time. So seems to be particularly advantageous at the moment if you're able to look through some of the issues that exist. Agilent specifically had a very interesting comment recently on tariffs as it pertains to their business. And I think this is why I would be optimistic on the tariff discussion in general. So they estimated something like $100 million worth of extra cost due to tariffs in 2025, which is it's meaningful. But they also estimated that in the first half of 2026, they think they can make changes to their business model, to their sort of re-engineering their distribution channels, if you will, to completely negate those extra tariff costs. So this just describes how dynamic businesses are, how creative they can be, and when you have global distribution networks, how you can move some pieces around the chessboard to make things maybe not as negative as the headlines would make you think. So we're fairly optimistic on a whole bunch of different fronts here.
So, Josh, we talked about Generac, and now we're going to talk about Shopify. Is this a similar story?
Yeah, in a lot of ways it is. It's similar in the sense that we've had very good success with the investment, and actually so good that I think Shopify is either very close to or the best stock investment that we've ever had. It's up about 5 times from the lowest price point that we purchased it at. So that's incredibly successful. I'm very, very happy to say that. But it's similar to Generac in the sense that we're trimming it for a couple of reasons. One, the current price is getting close to our target price after it had really good quarterly results a couple weeks ago. The stock price rallied significantly, and so we're getting close to our target price. The second part of it is just controlling position size. The position had grown as a percentage of our portfolio very significantly, and we always look to risk management first in those situations. We never want to be too exposed to any one company, because again, there are so many great companies out there to choose from. We think that we can diversify the portfolio better by having a lower percentage in each individual business. So from those perspectives, it's very similar, and we trimmed it for those reasons. It might still not be a household name, but I think if anyone that does online shopping, if you start to poke around your online shopping experience, you'll start to bump into Shopify more and more frequently, I think. And it doesn't show up as here's Shopify, right? But if you're going to the website or a retailer or something that you're buying, some type of product or service that you're buying, and you're going through the checkout process, often that's built on the Shopify platform these days. And if you look at the URL, sometimes you can see shop in the URL, like shop dot something. And you can tell that Shopify is building this platform, has provided the service to that company. The other way that I see it now is there's Shop Pay. So they actually have a payment processing system. So if you're checking out of whatever shopping cart you're in and it says Shop Pay, that's a good indication that it's Shopify providing that platform. And Shopify actually has an app now where all of the retailers show up on this app, all of their customers show up on this app. So it's a business that has a really long, what we think is a really long runway for continued growth. They're just growing in internationally in some countries now. They're just establishing themselves in new countries. And so this is obviously, you can think of the global e-commerce space. It's just a massive, massive market. And Shopify really seems to be the dominant player here. So it's always challenging to project the growth trajectory for companies like this that potentially it could be exponential. So you need to be somewhat guarded in how you're doing that and making those projections, but it is a really interesting business in terms of the growth potential that it has.
Yeah, they show up everywhere. They really do. You mentioned that there's a lot of great companies out there. When we talk about our investment committee and the effort that goes into it, can you, we've talked about it before, but can you give just a tiny rundown on how our investment committee makes the decisions?
Usually it starts with identifying an opportunity and then deep research from our research team. So we look at opportunities in a variety of different ways. We can run something called a screener. So it essentially screens or looks through the universe of different stocks that are out there for ones that have specific characteristics. Often we're looking for a stock that may have seen a bit of a pullback in price recently, and we're trying to look through that pullback as maybe something that's temporary, so we can find something that could recover over time. But the research part then starts. If we identify something, then we go through some very deep research trying to understand that business, the industry that it's in, what its role is in that industry, what its market share is. Is it a leader? Is it a laggard? Is it somewhere in between? What its competitive advantages are? And eventually we build a model for that company, a financial model that projects forward our revenues, margin expectations, its tax treatment, its earnings at the end of the day. And what we really focus on is cash flow. Cash flow is what matters to business owners. And so the company eventually, any good business needs to convert its sales, its revenue to cash flow, which is actually basically what ends up in the owner's pocket at the end of the day. So all of that goes into assessing a business. And then we put a sort of a risk metric on it as well, something that we call a discount rate to arrive at a target price. And only when we identify a good company with a target price that we think is reliable, where the price of the stock is trading significantly below that target price, do we actually look at adding it to the portfolio?
All right, thanks, Josh. I'm going to let you get back to doing all the stuff you do, all math.